So far we have seen the important patterns, and what is the importance of stop loss. We also seen the most important thing, that is the stocks life cycle. And we always want to have at least two or three such stocks which will be in their stage 2, which will be the growth state, and that is where exactly the large sums of amount of money is made. Now we'll start to check what exactly we should track and what we should avoid while building our trading strategies, or building your portfolio. Most common mistake, and most importantly what we should always avoid, is to stop investing into the fallen stocks. So this term is called as the broken leader syndrome. So what happens is, the stock basically somehow enters into its stage 2. Okay, then the distribution also happens. Okay, and then there is a massive decline that happens in the stock. Okay, now everybody who misses buying stock, and everybody who misses this particular multi-bagger effect of the stock, always thinks at all these prices that this is a better price, this is the better price. Okay, even this also they find as a better price, and they will uh, you know add positions into the stocks. So usually what happens is, the logic is that that x number of years the stock was, let's say, at 10 rupees, now also it is available at 10 rupees, so probably this is a good bit to buy. Okay, however, there are very strong reasons that the stock has corrected so much so fast. Okay, and most of the times you can also notice that the retail participation increases in these kind of stocks. Now, why institutions or even promoters themselves are not buying into the script at these levels? If there are very strong fundamental reasons which are already factored in by the stock price itself, so entering somewhere here is almost like buying a lottery ticket, and assuming that uh, this stock will somehow go up. Okay, now because we have understood, which is quite unlikely by the way, and so we should not invest any amount of capital into these kind of scripts. Now we cannot completely say that the stock could be turnaround story in some cases, unless there is very strong support from regulatory bodies, or let's say the promoter itself, or something really great happens with the company, let's say. Okay, now the stock will before that happen, the stock has to come out of this damage. Okay, so what will happen? Okay, so based on the stages that we have discussed, okay, what would be the next stage after decline? Okay, so there would be a lot of consolidations. Okay, and gradually there would be accumulation. Okay, plus fundamentally there could be some changes that will happen over a period of time. Maybe news like the promoter has increased their holding, or the company is posting profits on quarter to quarter basis. Okay, so let us assume, after we assume there are certain 3 quarters wherein this happens. Okay, and the price comes above 50-day moving average, it stays above it for 10 or 15 days additionally. That could be the actual stage wherein we might enter into the script. It's not necessary again to enter into the script, because we don't know for how long this accumulation period would last. Okay, it could be 5 years, 6 years, 7 years. So there are a couple of examples of these kind of stocks wherein they have fell down significantly, and now consolidating. We don't know where exactly those prices are going to go. We have this, as in we must have heard about these names, uh, Suzlon Energy, DHFL, Yes Bank. So these are a few broken leaders, and we should avoid entering into these kind of stocks. Okay, unless well, as in, to enter at this level there has to be, very strong fundamental reasons. Otherwise, buying for trading purposes doesn't make any kind of a sense. Unless you want to keep this stock with, absolutely spare amount of money, which you're okay with, losing out, and you're okay that the stock will eventually go zero, the company will get delisted. If you're okay with those kind of risks, only then you can, enter into these kind of things, provided that, this also happens, and, there are strong signals that, even the technical analysis is giving. Okay, we should always trade with the trade. Okay, now we should always buy when the trend is up. Okay, we should always sell, or we should always avoid sideways market, or, create shorts when there is a clear downtrend. Okay, now during the let's say you are a safe investor, you want to trade for long term, and you're okay with sitting on the position for, let's say, 3 or 4 months, or even 3 or 4 years. So we should avoid but monitor stocks which are in stage one, okay, which is the accumulation stage. But for me, it's also neglect stage. Okay, we should always neglect that stock, but we should monitor that, okay, what exactly is happening with this stock. Let's say, for example, Yes Bank last year corrected very much. Okay, so this stock we can just monitor, you can just read news, what is happening, what regulatory, support they are going to get from government or something like that. So we're just monitoring the price, where exactly is moving on, unless and until there is a very significant move that the stock is making. So for example, let's the stock is at 11 rupees today. So unless and until that stock is getting consolidated properly, all see, because what is going to happen with this kind of stocks? So the fall was so much that every time it is going to go up, everybody who bought here are going to book their profit and exit. So going up is always going to be difficult for this stock. Okay, and unless and until there is a strong technical setup and fundamentally strong reason, we should avoid stocks in stage one. Okay, now let's see the stage one completes, we should always buy in stage two. So specifically when the first base is created. Okay, now let us take another example. Let's say this is some new company, and the price is moving like this. Let's say it has done this move in last 3 to 4 years. Okay, and it is creating the base one. So obviously the moving average will be supporting these kind of bases over here. Then spike will come, then another consolidation. Okay, so probably we can try to enter somewhere here. Okay, or maybe after the second base. Okay, and then another spike will come. Okay, then more consolidation, and it will go on like this. Okay, and when there is a deep distribution that happens, we should be exiting. Okay, so this is the buy stage for us. We should sell in stage three when the distributions are starting, or the markets are topping out. And stage four is avoid. We completely short our scripts. That is this stage four, which is decline and markdown stage. So we should not be part of while buying into stage three and stage four. Okay, ideally we should be shorting the stocks here. Okay, so if you see closely, if you can identify stocks which are in stage two and stage four, so these are very strong buy signals, and these are very strong sell signals. Okay, and these are the levels where nothing more happens. So this is just distribution stage, wherein strong hands will keep on selling their stocks, they'll keep on exiting their positions, and unfortunately retailers will be buying into these levels. One important thing that we should do, we should always follow India VIX. So this is volatility index. Okay. I remember last time I exited my portfolio, India VIX was around 25, and last week also I think it is around. I think sub. I think it's below 25, but the volatility is increasing in the market. Volatility index gives very early signs of that something bad is going to happen in the market. And volatility or the index in India VIX is inversely proportional to the your main index. So if Nifty is something like this, okay, volatility index would be exactly opposite of this. Okay, it would be something like this. Okay, and if you just check the chart of India VIX, you'll get an idea that it has come out of a range. So it had created a range like this when Nifty was going sideways. Now it has come out of this range. Now India VIX is rising, and Nifty is mildly declining. However, it is maintaining certain support levels. Okay, so we are hoping that maybe for a very short term, Nifty might reverse. Okay, and India VIX will come down somewhere here and probably try to rise up. So now markets are in cautious mode. So I think if it goes back to this particular range, probably we might expect that markets are going to go higher and higher. But for now, it looks that the India VIX has come out of this very long range, and probably these are early signs that there could be some level of weakness in the market. Okay, but again, another week or another positive week might change the scenario. So let us wait and watch. So India VIX is very important that we should be checking. Now we'll talk about the chart setup that we should follow. So this is my chart setup. So we should always use log scales. Okay, the reason is on the single screen you'll get the complete picture of the chart, something like this. Okay, now this particular area may be of a larger move, but you might miss out on this information if your chart is linear like this. Okay, so it's better that we use log scale. So a certain area will get squeezed like this, and the log areas will be created something like this, and you get a complete picture on single screen. Otherwise you'll have to scroll up and down as well. Horizontal we anyways scroll, but scrolling up and down becomes a very tedious task. Okay, so our focus should be that we should focus on the chart itself and not constantly arranging the chart. So it's better that you use log scales and set up the moving averages in this format. So I use simple SMA. Again, you can use EMA as well if you're going to work on intradays. uh, so 20, 50, 200. So these are important basic timelines or moving averages that I follow. Uh, on certain growth stocks which are constantly going up and up, in those cases you can add 10-day moving average as a stop loss level. Okay, so below 10-day moving average, when the stock price goes below 10-day moving average, you can wind up your position. And 50-day moving average, or in fact 30-day moving average or 20-day moving average, you can just uh, apply these moving averages, and you'll get to know idea that when the stock price reaches to a certain moving average, it could be 10, 20, or 30, there would be more and more traders who will be buying that particular script. uh, so this differs from stock to stock. So every stock, like for example, we are following CDSL or let's say TechM. So like us, there are other also who are going to add to the position, or they are also waiting for a price correction. So when the price is going near and near to a certain moving average, obviously they will have a buying interest, and probably we might not get the stock at a certain price. Okay, so but this is again something that this is something observational item, that on a chart you just have to enable or disable certain moving averages and just get an idea that which moving average the chart has been respecting, and around that you can create a buy position, and you can keep a 10-day as a stop loss, and exit out from a position. uh, So again, this 10-day as a stop loss is again just a suggestion. As in, if let's say your support level is above the or the resistance level is above your 10-day moving average, so probably that could be a exit level too. Uh, Another thing that I do, I usually avoid use of grids. Okay, so the grids is basically the horizontal and vertical lines that you see. So those are the timelines for a week and for a month. Okay, and if we just see here, so I have cleaned those lines over. Those lines are not here, so I'll just enable those. So if you see these lines, so these are nothing but the time values. So you can see a fresh month starts from this line. Okay, it ends here. Okay, so this is the beginning of September, and this is the end of. Sorry, this is the beginning of October month, and these are ranges. The horizontal values are the price values. So if you see that this particular chart is equally distributed, you can see that everything is properly linearly placed. The price points are linearly placed. So what I'll do now, I'll just change this to log charts, and you'll see a small difference over there. Yeah, you can see that these particular values are overlapping another, because this is reducing this space. You can also see that the distance between these time gaps, or the distance between these price gaps is varying. So this is really useful when you are working on you know you know the stocks which have either corrected too much, or the stocks which have grown very rapidly. In those kind of cases, maybe you can make use of this particular chart style, that is by enabling the log scale. Okay. So that was all for my chart setup. Okay, and it's not necessary that you should be always using this setups. You can obviously modify. Uh, so you'll have to come up with your style. As I said, that some traders use 10-day as a moving average. Some use, in fact, 18 or 19 instead of 20. Instead of 50, some use 40. Instead of 200, some use 150. Some use 180. Okay, so whichever is going to work for you. So 50, 220 has been working very well for me, so I'm going to continue with that. Maybe with time I'll probably change it. Okay, so as I discussed in the chart setup, I use candlesticks instead of line chart or bar chart. Then I use log charts. So basically, you have to enable log scales. So all these options are in your other platforms as well. I use Zerodha and IFL. Both have these kind of settings. Then major MAs that I use is 20, 50, 200. So I usually exit based on resistances, buy based on supports. Time frame patterns, as Umang had asked, for positional, ideally you should be using daily. Then you reconfirm and check more resistances on weekly and then on monthly. Okay. For entering at a relatively better price, what I do in case I am in sitting in front of the computer, when I decide based on these time frames that on as per daily, weekly, monthly, I am going to achieve the target. So what I do then, I check the 75 minutes or 15 days chart. So what happens there is, on 15 days, maybe the price is way above 50-day moving average. So let's say this is 50-day moving average. Then we have, let's say, this as the 20-day moving average. So obviously there would be some correction, there would be some selling. So this could be my first buying point. Let's say there is some more correction like this, and this could be my second uh, you know buying point. So in case you want to buy a large chunk of shares, what you can do is on the next day you can find support levels on 50-day 75 or 15-day 15-minute charts, and try for the correct entry level. So most of the times when I create a specific entry level, that is based on 15 minutes charts. Okay. Sometimes if I want to take the trade in the morning hours, so probably let's say on 12th or 13th minute, when the 15 minutes candlestick is not there, so what I do is I'll check the 5 minutes charts. Okay. And by let's say 9:27 I will have, by 9:27 I will have these two candles at least, okay, for first 5 minutes, and there would be third dynamic candle which will be for which will be created for remaining 2 minutes, and probably I'll get a buy point and I'll place my buy order there. Okay. So it depends, whichever works for you, but this is what I follow when I have to create an entry